Hello, Steve Koukoulas here, Economist in residence with Zagga. And for the team at Zagga, wow, what a couple of months it's been for the economy and for the RBA assessment of the economy and what that might mean for interest rates into 2026. Now, in terms of the economic data, we've had a run of unambiguously better news on the economy. I think it's surprised just about everybody that GDP growth is above 2% for the first time in 2 years. And now 2% doesn't seem super strong, but given the productivity issues in the economy, given the fact that a year ago we were growing at 0.8% in annual terms, the pickup in activity is good to see, and it's actually starting to be locked in. And importantly, what's driving that? It's a pickup in business investment, much needed for the productivity problem that we've got. We've got a pickup in household spending, which has continued into the month of October. So that up-to-date data on the amount you and I and everybody's spending starting to pick up. And importantly, dwelling investment is also stronger. So while we are still a long way from addressing the housing shortage in Australia, we do have the early signs that dwelling construction is starting to pick up. Now, at the same time, we had a bit of a shock on the inflation results, both the quarterly and the recent monthly numbers, which I've touched on in the past, but they were higher than expected and higher by a considerable amount. Now, there's a debate, including from the Reserve Bank, about whether there's a series of one-offs, the unwinding of the electricity subsidies and these sorts of things are impacting the inflation rate, but are they the sort of thing that will force the RBA to adjust policy? The jury's out, and the RBA acknowledged that as well. But we would prefer to be seeing inflation a little lower than it currently is. The other thing that's really happening is the housing market. House prices are accelerating again after that little bit of a cooling that we saw in the first half of this year. The last 5 or 6 months have seen house prices really kicking higher, and pretty much across the board. Even the weaker cities such as Melbourne are kicking higher now, and the boom cities are booming again. So the Adelaide, Perth, Brisbane areas of the economy are recording really strong annualised double-digit growth in prices. And that's something, well, the Reserve Bank doesn't target house prices. They do look at them in terms of a wealth effect. So they would be a little uncomfortable with this house price momentum. And then the Reserve Bank itself. Well, we had just the December meeting of the RBA Monetary Policy Board. And as the Governor, Michelle Bullock, pointed out, they did not even contemplate a rate cut. And while they didn't say, look, we might be hiking rates, they were looking at scenarios where perhaps, just perhaps, in the months ahead, in the first half of 2026, if inflation is more persistent than they're currently thinking, if the labour market turns out to be stronger, that is an unemployment rate more towards 4% than 4.5%, then a rate hike is on the agenda. Now, I think it's way too early to be talking rate hikes, given that the economy is doing well, but it's not overheating. And so on that score, I think we're more likely to see rates on hold than a rate hike. And if it proves to be the case that this uptick in inflation that we've seen in recent months is just that, an uptick and a one-off, and we start to get inflation reverting back to normal when some of these things wash out of the data, the subsidies, for example, then we're going to be seeing inflation back in the target band. So fascinating into 2025. Now, season's greetings to everybody, all the Zagga clients and accounts. Hope you have a great festive and holiday season. Look forward to chatting to you in 2026. Cheers.